Hi, this is Randy Finney with RightSideOfTheChart.com, and today is Sunday, January 29th, 2012. Today I'd like to go over or do a follow-up video to the video I put up about a week or so ago, doing a big picture overview of the markets, primarily focusing on the SPY, the S&P 500 tracking ETF, as my proxy. And again, I started out last time with this chart. This is a monthly time frame, a 24-year span showing the primary uptrend line, which was broken back in 2008, and that marked the end of that uptrend. Of course, you can see the clear double top pattern in place. Do we push up, make a triple top? Do we stop here? Well, of course, that's yet to be seen, but I wanted to point out a few similarities or things to note from how this chart has played out in the past. These white lines that I have here are what I refer to as sub-uptrend lines. You know, this is the primary uptrend on the monthly chart, and you have these sub-uptrend lines, which are still pretty distinct, or I should say significant uptrend lines, multi-year period, from this one going from about 1994 all the way up to the market highs around 2000. And as you can see, quite a bit of a nice bear market that followed that breakdown. And here's our highs back in October of 2007, and then on the monthly frame in early '08 we had the breakdown here, and of course that was the bear market that just ended in March of 2009. So you can see quite the sell-off even from these sub-uptrend line breaks when looking at a big picture monthly chart like this. This is the uptrend line from the March '09 lows, which we broke officially on the monthly chart when this monthly candlestick closed. That is a July 2011 candlestick right there. So that began the new the new downtrend from that point. And as often the case with trendline breaks, you usually get an initial thrust down and then a retracement or a push back up. As you can see here back in 2008, that's what happened. If I put this, look at the horizontal line from where this retracement on that wave 2 up peaked out right about even with the trendline break, and that is where we are today. If you look at where we're at, this was the candlestick that broke down right here. So this, at this point where the crosshairs are, that was effectively our breakdown level, and prices got a little bit higher, but that's where we closed this week, or so far this month I should say. And a few other things I want to point out. Let me pause this chart and resize it here. Okay, what I wanted to take a look at here are a few of the indicators down below, and take a look at where they're at today. And let's zoom in here a little bit on those. Bear with me. Okay, a little bit of an over zoom. Here we go. Okay, if we take a look at this is the MACD histogram. The MACD histogram is going to show you the difference between the slow line and fast line. In other words, when you have a bullish crossover, when the fast line moves above the slow line, you're going to have a positive MACD histogram. And on bearish crossovers, you're going to have a negative histogram. Probably over zoomed again, so let me zoom back out a little bit. Bear with me, folks. I will sooner or later get the hang of this. Okay, here we go. This is zooming back out to long-term time frame. What I wanted to point out is all these indicators, particularly the rate of change 12 and the MACD histogram, as you can see, they've done a pretty good job of defining bull and bear markets. The ROC 12, rate of change 12, is in positive territory, or the MACD histogram. We have been in bull markets, and when both are negative, and what's nice is they tend to turn negative around the same time, so they tend to work well in confirming one another if you wait for both of those to signal, to give you a sell signal. So there it is. We can look at the bear markets. Of course, now begin bull market here, and the beginning of the next bear market. And now we need to zoom on in and take a look at where we're at today. Okay, so we sort of have some mixed signals here. You really can call it either way. The rate of change 12 has been declining, and we've had a few sell signals, but very brief, nothing to to really say that that one's gone one way or the other yet. We're sitting right around the zero line. But the fact that it has been declining and going towards that level indicates, again, we're at an important inflection point. It can push back up, and if the market wants to go on and make some additional highs, or we could fall back down by the end of this month, or I'd say, well, February. We're not going to know much in January, regardless of what happens, since we only have a couple trading days left here. And the MACD histogram, as you can see, has been on a sell signal as well. They both went on a sell signal back in, let's see, that is September. So just something to note here that we don't have a lot of whipsaws when you take a look at both of these in conjunction. If you're looking at both of them being on sell signals, looks like pretty solid indicators. But again, these are long-term monthly charts, monthly indicators. They are anything but timing indicators. It's just something to help you determine where you are in the bigger picture of things. Okay, moving forward now to a SPY weekly chart. This is a weekly time frame, and what I want to do here is highlight the similarities between the market top and subsequent bounce after that trendline break back in 2007, 2008, with the top that we've had so far in May 2011 and where we are today. Okay, let's zoom in a little bit on this one. We're focusing on price action at this point, and then I'll talk about the indicators next. So price action on a weekly chart, what you see here is, you can look at the crosshairs, and the box on the upper left hand corner shows you the date. This is the week of Friday, May 23rd, 08. And what you see here, let's zoom in a little bit more, is the candlestick wick, which shows at that point we had a false breakout. Breakout of this uptrend line, which clearly came off the top. A lot of traders are watching that. If you look at the week before, that was actually the third or almost fourth touch. Actually, we have a couple candlesticks back here. So we had a pretty well-defined downtrend line. And then this week we had a breakout, which by the end of the week failed. That's what the wick on the top represents. Prices got above that level but failed to close there for the week. And then the rest, as you all know, is history. So I wanted to point that out and make mention that we've had virtually the identical price pattern so far. This week we finally had a break above the downtrend line off the highs back in May, and prices shot up above and closed right about back on that trend line this week. So wanted to point that out, that and I had made mention of this before, that I wouldn't be surprised to see a fake out, a false breakout that may last for as long as a week or even two above that downtrend line. So we're far from out of the woods yet, on the long side. I think we're still at a critical market juncture here. Let's look at some other similarities. Let me pause this and move. Okay, and now we're looking at the indicators down below, and I'll just go from top to bottom here. The similarities that I wanted to point out. Let's give this one a little bit more room. Here is the MACD. One of the longer term indicators I use on a weekly time frame is a simple bullish or bearish posture of the MACD. That means below the zero line. This dotted line in the middle is what's known as the zero line. Typically when the MACD crosses above or below that line, those are bullish or bearish signals. And right here, what I wanted to note here in the circle is very similar posture on the MACD, both after the top in the market back in 2010 into that first push up to retest the trend line in May of 08. And notice how we failed here at the zero line. Now, when I use this indicator, I prefer to use the slow line, which is the EMA, the 9 period. I refer to as the slow line, the blue line, the fast line. That is the line that has signaled bull and bear markets. And you'll see, if you go back a little bit on this chart, I'll let you put it up on your own, you'll notice that you've had a few whipsaws if you would have followed that blue or fast line, but a lot fewer if you just focused on the white line here. And again, I'll probably put that up in a chart on the site later tonight. So as we stand right now, we have the fast line, or I'm sorry, the slow line right up around the zero line, really virtually on it at this point. So we're either going to move up from here, and that would be just one of many signals that might change from bearish to bullish in the next week or so. And of course, give it a little room. I wouldn't put it on an all-out buy signal, if it crosses over for a few days. So we watch that, and if that continues to move higher, then that is one less sell signal in my book, longer-term sell signals on the market. Okay, let's shrink that down a little bit. Take a look at volume. Again, here is the push back up, what most of the Elliott wave counters refer to as a wave 2. Push up before the big powerful wave 3 down in the last bear market, and that's where a lot of people are comparing, at least some people are comparing to where we are right now. And if you look at the volume, basically same story on the volume back then. We had a breakout. That breakout I mentioned earlier that failed was on lackluster volume. That's right where the cursor's pointing. Just what you want to see on a breakout is a move above that level on much higher, usually 1.5 times volume, and we didn't see that then. The move up leading up to that was on declining volume, virtually identical to what this move up has been. If you note here, you see the declining volume off the lows here, and we broke above the trend line this week, but on very lackluster volume. So volume patterns are very similar to that point. And then finally here is the RSI, and if you take a look, both back then and now, we came off the oversold level. 30 is considered oversold on an RSI. It's banded between 0 and 100, but any readings below 30 is considered the market is oversold. And we pushed up from the near 30 level to just above the 50 level. Where that's significant, a lot of traders view a cross above or below the 50 mark as bullish or bearish. So again, this just added to the what we call bull trap here. We had a price break of a downtrend line, which is a bull trap in itself. We had the RSI moving above 50, which probably brought a lot of traders into the market on the long side. And then, of course, prices went back down. And that is about exactly what's happened on this move off the bottom. We came from right around the 30 level, oversold, and we have crossed above 50. Of course, we're a little bit higher now, but I don't think we're clearly out of the woods yet. And again, price is first and foremost. Okay, moving on to the daily time frame of the SPY. I'll touch on these fib time zones that I've talked about a little in the past. I do tweak these from time to time, and this one I moved it a little bit, just slightly from where I had it on the last chart that I put up. I did notice this candlestick here, where it is lined up now. This was the high back in May 3rd, I believe, and this was the actual low, this candlestick here, where I've moved it to. Let's see, that was, if you look on the upper left-hand side, you will see June 23rd. Okay, and then as you can see, these project, we had a turn around this point. There was a bottom. We pushed back up and had a pretty sharp drop price-wise on that one. This one looks like it just missed by a couple days. This low here in October, and here's where we stand today. The next turn, we're just a couple days off there, so just something to keep an eye on. And again, as I said before, I haven't used these much in the past, but I do find them pretty interesting, and how they've lined up, and just something to keep an eye on. Okay, so looking at the downtrend line off the May highs, as you can see, we had a breakout, and we had which went a little bit higher. We had actually another follow-up day. And as you can see, this breakout, just like on the weekly chart shows, was on very lackluster below average volumes, which is a red flag in itself. I actually realized I didn't have the indicators included there. Bear with me. Okay, this should have everything on the chart. Indicators are down below now, and we have what I wanted to point out. Here's the recent breakthrough. Pretty impulsive failure back to that trend line. At this point, that's nothing but a retest of a breakout. But the red flags on this breakout, as I've been continuing to mention, are the below average volume. We've had declining volume leading into the breakout, and even to my surprise, I figured we'd get a little bump, but not a whole lot. So we did not have above average volume on this breakout, which would have really helped the bull's case. And again, the market is so overextended that that doesn't surprise me at all that we don't have a lot of traders jumping on a breakout at this level. Okay, let's zoom this up and take a look at the MACD for a second. Here was nice positive divergence into the lows in October, which led to this nice move up. And from that point on, I should add a trend line here to just show you point to point. There we go. This is negative divergence. You have a higher peak in the MACD here and a lower peak. And what's more important than that is we're also about to get there are no guarantees, but it looks like we're curling down here. The fast line is quickly curling down, looking like it's about to make a bearish crossover, which would put in place that negative divergence. In my opinion, we don't have this MACD is still trending up, and until it turns down, putting in a lower low, we don't officially yet have negative divergence, but it is definitely setting up in place. And if you take a look at the histogram down here, this is the MACD histogram. As you can see, we're clearly heading that way. Unless the market were to take a pretty sharp move up. Okay, let's take a look at volume, which I've already covered. Declining and lackluster volume on the breakout. A few other things to mention here are the RSI. Let's zoom out a little bit on this chart. And typically RSI readings of 70 or above are considered overbought, and they usually lead to a correction. So if you look here, we hit 70 at this point. Market kept going for a little while, made another push above 70, and then followed the vertical line up to the price up here, and you'll see we had a pretty sharp correction. Here was an extended overbought reading, which went on for quite some time, and then finally led to a pretty good pullback. And then from that point on, we've seemed to have pretty decent pullbacks every time we've gotten up or near, close to, or above the 70 line. So as you can see, the pullback started there, was pretty significant. And here's the next overbought reading. Had a little push up to almost that level, and then that very sharp sell-off into August. We came close here, didn't quite get there, but we had a nice pullback. And here we are again today. So again, this market can continue higher if it wants. Overbought markets can continue to get overbought, but I would put the odds pretty good at a pullback at this point, or at least urge caution on your remaining longs. Maybe move the stops up and be very judicial on what you take. New positions, long positions that you're entering at this point. Be very cautious with those. Okay, final chart on the SPY is a 60-minute chart. Last week I put up the bearish rising wedge pattern in the S&P 500, or the SPY, and as expected we did get a breakdown there very late in the week, so that pattern has now broken down, which is, in at least my book, a sell signal in the near term, very short term. And what's interesting is this pattern, if it does play out, there's several methods for measuring or projecting the price target on a pattern. One of the most simple is just take the distance, the widest part of that wedge. So you look at the prices here from the top of the wedge to the bottom and put that at the breakdown level. Happens to coincide very nicely with horizontal support here. You have some gaps in there, some reaction highs, so that in itself is a good support level, and also a projection for where prices may go. Now, if it does play out to this level, that would of course bring prices back down under that key primary daily and weekly downtrend line, therefore causing a bull trap. Might not be the most vicious bull trap because we didn't have a lot of traders pile in, but then again, when we look back at the one in 2008 back in May, we didn't see a lot of volume on that either, and the subsequent selling was pretty serious from that point. Okay, guys, in wrapping this video up, last thing I wanted to touch on is the other key index that's followed, the Nasdaq 100, or the Nasdaq itself, the Nasdaq Composite. The QQQ is the tracking index for the NDX 100, and what we see here is we have pushed out now to a new multi-year high. Same story as with the SPY and most other indexes, on very low volume. We don't see any confirming volume across the board. Well, I'm actually cut that off. You can't see that in this video, but down below there's very low volume. Same story. The RSI has now exceeded overbought readings. We're just over 70. Now, most importantly, what I wanted to point out here is the Elliott wave possibilities. I personally think Elliott wave has its place in trading, and I do use it to some extent. If the wave counts are clear, I will factor it into my analysis. Although I am not an Elliott wave expert, I usually defer to others on the more complex counts. And personally, if a count's too complex, too subject to revision, I really don't put a lot of stock into it. However, I've heard it said lately that this market, those that compare this market to the top back in 2007, 2008, well, you look here and you can see that the wave 2 up never exceeded the initial move down from wave 1, which started back here, and now we've pushed above this level, which makes the odds of it being a wave 2 up impossible, because wave 2 can't exceed the beginning of wave 1. Well, what I wanted to talk about here is the fact that every other key index out there has not pushed up anywhere close to close to the original highs. Let's take a look at the Nasdaq Composite here. That is every stock in the Nasdaq. You can see we've clearly have some room to go before we exceed the recent highs up here, this level. We're getting close, but we're not there yet. And most importantly, what I wanted to talk on is this little dynamo. We all know, I think the latest news blurbs on Apple, it's the largest, either the largest technology or the largest market cap company in the world, one of the two. There's no denying Apple has just changed the world with its products, and has really carried the markets, particularly the Nasdaq 100, with it. Now, what I wanted to talk on is the fact that the QQQ, or Nasdaq 100, which is the only key index that has made new multi-year highs, has done so largely in part due to Apple. Apple is, as most of you probably know, the largest weighting in the Nasdaq 100, and that's, in my opinion, not a very balanced way to look at the market. If you have Apple, which currently, let me look at my stats here, at this point in time is just over 15% of the Nasdaq 100. Just to put things in perspective, Microsoft's the second largest holding at less than 9%, 8.73. Then you have Google, 6.61, Oracle at 5, just over 5%, and Intel around 5%. So what we need to do here, in my opinion, is take a look at the equal weighted Nasdaq 100, which just puts an equal weighting on each component, and voila. As you can see, we are not in any immediate threat of an Elliott wave count, as this being a wave 2, being ruled out, because we have still a ways to go before we get up to the recent highs here. Another thing I would advise looking at is the Nasdaq Composite, which has, I don't know how many different stocks within it, but as you can see, not even close. So take a look at the equal weighted Nasdaq 100. Just for reference, there is a tracking stock, an ETF for that. It's QQQEW. Obviously, it's going to look like that NDX equal weighted chart that I just put up. But so there you have it. As far as those trying to rule out a possible wave 2. Sure, in the next few weeks, if we take out the highs on these and some of the other indexes, like the small caps, there's 2,000 stocks in the Russell 2000, and there we are, hardly anywhere close to the recent highs. And you can go down the line, take a look at different indexes, and we're still a ways away. All right, folks, I believe that is it. So I'm going to stop here. We're just shy of 25 minutes. Hope I didn't put everybody to sleep. And I'll put some other charts up tonight And I have a few other video updates that I wanted to work on this week. So check back, and good trading this week. Stay safe.